Hi, welcome to the fourth class of the complete course on Indian stock market. In this class, we are going to know more on the risk side of investing into stock market. The headline which we have kept is what are the different type of risk of a stock market. Well, I have been telling about this fact in last three videos that there are some very visible risks which we all understand is like if market will come down, uh, everybody will lose money, people who have invested into those stocks. Similarly, if one sector will down, again people will lose money, especially people who are concentrated in those sectors. And obviously there is a risk which is associated with the stock also, stock specific, not a risk, a type of risk which will be associated with one stock also. So these concept I have told you in previous videos. I now going to tell you about what are those specific risk which basically impact market and the whole sector itself. So for that we have to go and understand what are the different type of risk one business can face, because investing into stock market is nothing but investing into businesses. So in this video we will stick ourselves to only and only stock risk. Okay, I know you all understand by now that market risk is there, industry risk and sector risk is there, but what are those stock specific risks which are there which you need to be aware about? See, knowing at cognitive level, everybody knows this, that there are different kind of risk which is there in the market, but you need to know basically that what are those kind of risks. Whether you will be able to manage them or not manage them is a secondary matter. At least it will raise a red flag if you are aware about this, if you have heard about these kind of risks once. So it was very important for me to include this into the topic, that we will discuss what are the risk which businesses face, and when businesses face, obviously it will impact the stock price. So I have listed down few different kind of risk. There are approximately 9 to 10 risk which I have listed here. So this whole course, whole chapter, this video, this topic will be divided into two portion. One, theoretical part where we go and understand about these kind of risk, and then there will be a example where you will see that why even a small change in profitability due to these any kind of these risks result into a big fall into stock prices. So we will learn about that in the second portion, but first we will go and stick to the theoretical part of this chapter, which is like what are the different type of risk one company can face, one stock can face, one business can face. So I have listed it down, and so the very first risk which we are going to discuss is commodity price risk. So let's take one example of commodity price risk. So if you have heard about, let's say, crude oil, right? You all know about crude oil. So there are companies who produces crude, right? And there are companies which refine crude and convert them into the final produce like petrol, diesel, gasoline and other stuff. And then there are companies which market these products as well, you know, so they are the distributors. So if we need to actually understand this, let's understand this way. Kane Energy in India, they produce, so they go basically onshore and they dig and they take out crude. Okay, so we can call them their crude manufacturer in a way. Then you have a company called Reliance Industries, which is into refinery business. So they refine this crude and further convert it into the final produce. Then you have companies like BPCL, HPCL, Indian Oil. So these are those companies who are called oil marketing companies. So they get the oil and they finally distribute it and they earn money. Then there are companies which are dependent on the oil prices as well. So let's say the paint industry. One of the major component in paint is the petroleum product. So if the petroleum product will go high, the prices of the petroleum product will go high, then the profitability of the paint companies will come down, because the raw material is petroleum produced and petroleum produced prices are going up, and that's why it will impact their profitability. So this is one example. The similar Okay, so for a paint company this is not working in its favor, the price which is moving up. But consider from the perspective of a oil manufacturing company, companies which are basically digging and taking out oil from onshore. uh, then they finally have to produce oil and sell it. So if the oil prices are going up, they will be profitable. So commodity price risk is there. Okay, so for people who are taking this as an input, the raw material, the commodity, for them, if the prices is going high, it become a risk. And companies for whom this is one final produce itself, it may also become a risk when the prices will come down from a threshold. So you understand this part now, but you must be thinking that well, what about the other companies who are not dependent on the price fluctuation of most of the commodities which we use? Well, if one commodity is going higher, other commodity prices will also go higher. In the same example of petroleum produce, let's say in India, most of the product, I mean most of the transportation happens via trucks. Now if the petroleum prices is going high, what will happen? The freight, the charges, the transportation charges will go high. So every other commodity prices will also go high. And at that point of time, that will be called like, okay, so the economy is little sluggish, people have negative vibes about it. So it can actually impact the whole economy also if altogether a lot of commodity prices are going up. So most of the companies faces this commodity price risk for sure. So now you understand that you have to watch the price of the commodity, which is either the final produce of the company you are invested into, or one of the raw material that commodity is for the company you have invested into. So even if you are invested into a petroleum company or you have invested into a paint company, in both of the cases you have to also keep checking the price of the petrol, right? So similarly, this commodity, other commodities also impact the economy, also impact different companies performances, right? So commodity risk is one risk. Then the second risk which is there is headline risk. Well, what is headline risk? So in 2008, if you remember, subprime crisis was in US. We hardly had, okay, we have a dependency on US market for sure, especially the services sector. But as such, businesses didn't get stopped. As such, TCS or Infosys billing didn't go down, But the negative environment, the distressed environment which came because of the news headlines which was always coming about the subprime crisis of US impacted our market also badly. There were problem, but not that deep problem what it was in US, but India market also got impacted. So these headline risks are there on the economy level also, on certain sector level also, and certain companies level also. So there could be no issue in the company, but still it may come into the headline. These days media frenzy, people are there, that anything, any rumor can come, and for a short time the company prices can go down. I mean, the company can face a lot of issues. So headline risk is another type of risk. Without doing anything wrong, a company can get into mess for a shorter period also. So you need to understand that what is the right news and wrong news about the company you have invested into. Conviction is something which is very important, but you cannot deny that this headline risk is not there into the stocks or the company you have invested into. Then the third is the rating risk. So there are two type of ratings which people are generally dependent on, companies are generally dependent on. One is called the credit rating. Credit rating is the rating given by credit agencies. So let's say you got a good credit rating, then what will be what will happen, what will be the outcome? So if you got good credit rating, what will happen, that you will get cheaper loan. So lending companies will, so see, companies which have issued stocks, to raise fund, the same company have chosen debt also as a mode of financing, which means in simple terms, when company have to do business, they raise money either in the form of debt or equity. So they take loan. Debt, when I say they take loan, so the loans comes from different rate. Even if you see in your own life, you will see that housing loan comes at 8%, 8.5%. But if you go and take personal loan, it comes at 14%, because risk in housing loan is hardly anything there, because the house prices will not go down and the house has been kept as a collateral against the loan. But on the personal loan side, there is no collateral, so they comes on 13-14%. So similarly, if a company is having good credit rating, they will get cheaper loan. And if the credit rating agencies go and downgrade the rating of those companies, what will happen? They'll start getting flake from the people who have lent them. They'll ask them to increase the rate, and new financing also will happen at higher rate. Now if you are getting loan at higher rate than what you were getting at, it will impact your profitability for sure, because whatever the profit you will be making, you will be giving a good portion of it as an interest. Lot of companies, I'll tell you, especially steel companies like Bhushan Steel and few other companies are there, which you can see that JP Associate, uh, Unitech, lot many companies. There are so many examples where the companies rating agencies went on going down, and their loan becoming expensive. They were not able to pay the interest, and finally companies gone, I mean, shareholders lost a lot of wealth there in these companies. So credit rating agency is there, and they rate these companies credit ratings. It is one of the important rating for financing the business, and this risk is also there. Within the rating section itself, there is another rating which is given to the companies, are the rating of the share prices or the businesses by the rating analyst people. So collectively, if they also, I mean, sometime, even if it's a kind of malpractice where they had certain differences, or they are not very much optimistic about one company, a group of rating agencies, a group of analysts can go and give bad rating for a certain period, and at that point of time a stock may come down. So these kind of ratings impact a stock price for sure. It is important category. You have to keep watching what are the being rating given by the majority of good fund houses, and also what is the rating being given as a credit rating to the companies, because credit is something which is very important. It is one of the mode of the financing. So that financing has to be cheaper, and it will be only cheaply available if you have a good rating agent, good credit rating. So credit rating is another important type of risk which every company faces. Obsolescence risk is a risk. So it's something like dinosaurs are not there, right? I mean, there are so many other species which will be not there, and it applies, it's a very, very philosophical kind of thing that, there's no such thing which will always exist. One or the other thing, it will get the competition from one or the other thing. Anything can happen. The model can go obsolete, or so you would have seen that top Fortune 500 companies which were there in top 500 companies of the world 30 years back, hardly 4 or 5 companies will be there right now in Fortune 500. So every 10 years, 15 years, businesses change. I mean, these days, if you see in India, you have a lot of dependency on companies like Amazon, Flipkart, and if you see 10 years back, 15 years back, there were different kind of companies on which you were having the dependency and you were using their product or services. So generally, I mean, this is kept into a category of obsolescence risk, where philosophically people think that one or the other day business models will change, and this is one eternal truth that companies, you know you would have heard about example like Nokia. Everybody used to buy Nokia, use Nokia phones, but what happened when the Android or the Apple phone came? For a very long time, till the time Microsoft didn't acquire them, that company went into a very, very uh, bad mode, bad phase, where shareholders lost a lot of money there, right? So this eternal truth that nothing is going to survive here for always, is applies even for the companies. So you have to keep watching whether you are exposed to those companies which are basically futuristic company. And not only that, since they are here from last 25 30 years, it doesn't mean that they are good. There will be, like in India, you have Tata Group, you have Reliance Group. I mean, they came 30 years back. Tata Group came probably 60 77 from the time of independence. I think these two houses are there, but even if you compare Birlas, I mean, they have not grown as Tata has grown. They were contemporary when country got freedom, but and they were the two business houses, but there were so many companies you will find who are doing better than Birlas, right? So this is more like a philosophical kind of category of risk which is there with the stock market also, and we call it obsolescence risk. So you have to keep a watch on whether you are in the futuristic business or you are exposed to only the businesses which you believe that since they were 30 years back, they are still there, and they will be still there after 20 years. So this visualization, this philosophical take, you have to also apply when you're going to invest into any company, and this risk is there for sure. Then you have detection risk. So see, this risk class, I know it's going more like I'm talking to you than showing you data or something. But I'm giving you example, and we have one example here, Satyam. So people, obviously, if you are a young kid of 20 years who is taking course and in doing your graduation, 10 years back, yeah, so approximately 10 years, 12 years back, we had a big case of Satyam. Satyam was one of the top five Indian IT company, like TCS, Infosys, HCL Technology, so right now Satyam is taken over by Mahindra Group in Tech Mahindra. So uh, Satyam case was like the promoters themselves were involved in siphoning the money, you know, and they had a very reputed auditor, and still, I mean, some people says that conspiracy theories that they were aware, but they didn't take out because they were probably unethical. I don't want to make a comment here. I mean, the point here is they were fined. The auditors were fined for this mistake. So sometime, even after doing all the measures, detections of something like a fraud, comes very late, and by the time it comes out, people don't get a chance even to come out of the stock. And by the time it come out, I mean, there are only seller in the market and no buyer, because nobody want to touch such companies where you have such kind of fraud issue, where promoter themselves are siphoning the money, auditors are not detecting it from years. So you never know how deep down the problem will be, so it is very important that we also understand this part, that even if a company which is have been audited by one of the best auditors, and even if you know that the company is there from last 10 15 20 years, there could be malpractices into that company which cannot be detected into time. And how to manage it is something which I cannot answer here right now, but yeah, I mean, we will learn about this in later chapter of risk management, which we will certainly cover, and in its third section or fourth section of the whole course, you know. So detection risk is more to do with the detection which were supposed to happen during the audits, but it didn't come out in time, and by the time it came out, it did hell lot of damage, so this risk is already there, always there. You can go and read about Satyam case further and you'll come to know what exactly happened in Satyam. Otherwise, Satyam case study is anyway part of the class. And at the end of the whole course we are covering 15 different case studies. That time we'll cover it also. Okay, the next is legislative risk. So obviously you are all these companies are they are into under one of the democratic country like India. If you're talking about India, the government keep on changing rules many of the times. So at that point of time companies also faces different kind of risk, because suddenly if government have changed certain rules, so let's say for oil marketing companies, so how does oil marketing company work is you uh, government tell them that whatever the oil you are selling you can keep 4% cess on that. Now one fine day, just because government think that oil prices are very high, they will change the rule and they will say that okay, not 4%, but 2% is something which you can charge. So whatever the price at which you are buying the petrol, on top of that just have an add-on of 2% and sell it to the consumer, because this is one produce which is impacting the economy as a whole. And oil marketing companies has to obey, because they are under the influence of government also have a say in those companies, and government can dictate as well in certain sectors. So this kind of legislation risk can be there for the companies as well, which can come overnight, and this can create an impact for a company where you have invested. So legislation, there are so many different kind of legislation changes which has happened in past, and it has impacted the company's performance or a shorter time or for a longer time in fact also. Then you have inflation. If you know about inflation, it is like the prices of the all the commodity which a common man use. So if there is a high inflation, inflation and interest risk, two different risk I have taken here, but let's talk about them at a time only. So what happens that this inflation and interest risk, chicken egg theory keep on going into every economy. So when inflation is high, uh, to curb the inflation, what the central bank RBI does is they increase the interest rate. So when they increase the interest rate, what happens that the liquidity suck outs from the economy, and the inflation comes down, because people stop consuming that much what they used to consume in a normal day. So inflation is one thing which certainly impact stock market in shorter period and even in longer period. If you have high inflation, interest rate has to go high to curb the inflation. Now if interest rate will go high, mode of financing will go again expensive. It will become dearer for most of the companies who are who have raised money also through debt market. I mean, every company who has raised money from the equity market, they would have certainly raised money from the debt market as well. Even for a company like Reliance, they are under a huge debt. They also pay, so it's the largest company of our country at this point of time. But if I'm not wrong, you can go and see their sheet. They are also taking a debt of almost 1 point. Let's see, I mean, we can go to screener and see what kind of debt they have taken. Oh, so I can tell you that Reliance is having a debt of 1.5 lakh crore on their book at the moment, anything approximately like that. So inflation risk and interest risk. These two risks are, in fact, I have written it at the very bottom, but they are very, very critical risk, and you have to keep watching the inflation number. you have to keep watching the interest rate announcement from RBI every quarter, because they are going to impact your, in some cases. So there is a company which is like have not taken any debt. So companies like TCS, Infosys, they have only surplus cash left with them. These are the companies, service companies, they are not under debt. So for them, probably it will not impact. But for a company which is under huge debt, debt equity ratio is really high. For those companies, it will impact like anything. The high inflation and the high interest rate both, and both goes along. If inflation is low, probably people will be not much bothered about increasing the rate also, the interest rate. So this is two other kind of risk where you are exposed. Then you have model risk. So model risk is more to do with, I spoke about this risk called obsolescence risk, but model risk is more to do with, a company model can, that was more philosophical, where we said, or where we understood that something which has been built can basically uh, will not survive for always. Everything has a period of your survival. So it was more on the philosophical side. On the very practical side, what happens that business models which has been running from long time, or from short time in fact also, can get disrupted from the other models, and people start buying them. So probably a company like uh, Kodak, who were very good at probably making cameras, but they didn't revolutionize themselves in the digital form, and that whole business model collapsed, of people who were not inventing or not putting good money into R&D so that they can come with the digital camera. So the whole business model can change actually. So there are many other examples where you can find that the model of the business itself got changed, and a company didn't even get a chance to basically react to that change. So it is always said that change is the only constant. A lot of people would have made this statement, you would have read it also. So point here is model risk is also there. The model can fail. The business model which is working from last 4 year, 5 year, 10 years can one fine day just fail because a disruption has happened into that industry. So model risk is also there, and you have to keep watching that for your competitors as well. So these are the theoretical, this is the theoretical part where you saw that there are different factors which act as a critical risk sometime for the company. Out of these 9 or 10 risks which I have discussed here with you, it may be possible that company which you have selected only 4 or 5 apply. you know but idea is, when you know about these risks, when you have heard about these kind of factors, every time you are going to buy a share, you will be more confident in terms of that, okay, I'm buying a petro chemical stock, and then oil marketing company stock, and all I have to be worried about these three factors which I'll keep on watching. So knowing risk in advance is important, and you do not have to mug it or something. This is especially a message to the students. You have to more like understand it from the economic perspective, from the perspective of a business rather, I would say. Okay, so these are the different kind of risk, and now quickly we will see that why a small risk and even a small change in profitability can disrupt the business, can disrupt the stock price in the short term, uh, for which we have to go and open one compound interest calculator. So what happens that there is a company which is posting every quarter, let's say, 100 crore profit, and this 100 crore profit is probably their 4% of the quarterly, 4% of the total book value. Well, in this case, what happens that in the coming quarter, or if I'm saying 4% weekly, then I can take 16% annually. So let's say book value of the company is 100 rupees. At 16% it is growing, and people who have invested in the future value of this company, so stock market is all about future value, you know, you can see that 100 rupees in 30 years become 11,771. Okay, now let's say instead of posting 100 crore profit, this company posted only 75 crore profit, which means the profit has come down only by 25%. But and just for a quarter, but you will see that there is a huge drop in the stock price, so you would always wonder, okay, companies is still profitable, company has posted 75 crore profit, and even after a 75 crore profit, why the company stock prices have gone down? So they go down drastically even after a single percent change, is because market means the market participant has invested into the future value of the company, and the future value when keep on compounded, they become really huge after 25-30 years on a higher rate than a slighter lower rate. So you would see that every time you get to know about these kind of risk which exposed one company and further has also resulted into the loss or lesser profit for the company, it impacts the share price drastically because of the power of the compounding factor. Well, if power of compounding helped the company project a very good return and making the company 100,000 times bigger from today's date, it also impact adversely when the profit number or the sales number goes down. Sales number may still go up, but if the profit number is coming down because the company has got exposed to anything like credit risk or rating risk, then at that point of time share price can go down drastically in that quarter, even by 25%, 30%, 50%, because then the discounting happen from a very lower future valuation. Okay, so in this case you saw that a company growing at 16% become 12,000 rupees from 100 rupees, which is like 120 times. And if we just decrease the future income by 4%, what we see that the company is just growing by 30 times. Well, the discounting will happen from that 3,000 rather than from that 12,000, which will further impact the stock prices and take the stock prices comes down like anything. Well, so idea or the philosophy of the first 12 topics which I have identified is to basically give you a glimpse of the stock market. Make sure that you know about basic concept, inflation, different kind of risk, businesses, power of compounding. You have heard me enough talking about all these things, so that by the time we start working on the real chapters, from the next segment, by that time you will be comfortable enough to assimilate all the information as form of concept, and also can correlate what I'm talking about, I'm talking about in these topics, which are like the common or the frequently asked questions from different people. Well, so in this class, what we summarized basically is, let me summarize this class. So what we basically learned today is like, at company level, because every investment in the stock market is basically investing into any company. So at company level, what are the different kind of risk which are there in the market, and we learnt about those 9 kind of risk, 9 type of risk. and then later we saw that how power of compounding adversely affect these companies stock prices in the current market price. When we will be doing the relative and intrinsic valuation, we will learn this part in much detail, but since we are talking about risk, it was very important to show you people that number in quantitative part, that how a slight change in profit can result in even 50% drop of share price. I mean, to give you an example, 1.5 years back, oil marketing companies crashed by 50%. The only change which has happened was government gave them a mandate that instead of charging 4% cess, they will charge only 2% cess. What does it mean? It means that their revenue will simply go down by 50%. And if the total revenue will going down, profitability will be going down. I mean, the profitability will go down by 50%. So if the profitability is going down by 50%, or even the revenue is going down by 50%, it can be a big hit for any company, and it reciprocated in the share prices also. Those companies fell by 50%, some by 60% as well. So on one side you need to know the risk, and on another side you also need to know that even a small risk can basically create a huge impact on the share price. Well, am I trying to make you fearful from the stock market? No, I'm just making you aware about what are the different type of risk. Otherwise, the kind of return which a stock market offers you is much better than the risk. What I told you, people, most of the companies which are big companies, they always try to mitigate these kind of risk, and even if they are not able to do, due to certain risk management practices, you can mitigate some of these risks also. Like in previous chapter when I told you, by shorting Nifty future you can control the market risk. By diversifying your portfolio into 6-7 sectors, you can mitigate the sector risk. And on the company risk side, how we can manage this risk is something we will learn into the risk management chapter in section 4. Well, this was your class 4, and which was about what are the different type of risk which are available into stock market. I'll see you in next class. Thank you.